Okay, well, two people managing two different AMCs with two different products joining on the show today, as I said. So that was Prateek Oswal with the Motilal Oswal Asset Allocation Passive Fund of Funds, the two offerings, aggressive and conservative. I'm guessing that there's no doubt to who the next offering that is from the Edelweiss stable is aimed towards, but I'll let Gupta come in and talk about that. They are going to launch the Edelweiss Nifty PSU Bond plus SDL Index Fund 2026. That's a long name for a fund. Radhika, thanks so much for joining in. Tell us, what is this offering about?
Hi, Niraj. Good to be on your show and talk to you after a long time. I think the commonality I have with your previous guest is both of us are launching passive funds, so from different AMCs. So that's the commonality. It's a long name, unfortunately, for a very simple product. But incidentally, this happens to be actually the first debt index fund to launch in India, which is exciting. I think, and I'm just going to go back to a previous product line, which was Bharat Bond. The whole concept of debt passive products came in and target maturity funds came in. Target maturity products were ones where you had a defined time period, whether it was 3 years, 5 years, etc., and you just held a buy and hold strategy. It worked really well for the investor because they knew the portfolio, they knew the indicative yield, and even in this, by the way, yield rally, none of them kind of worry. Now, that was a PSU segment product. We decided, why don't we expand the basket and make it a 50% PSU and 50% state development loan basket product. So it's a very simple product. It takes off from the success of that, but makes the portfolio 50-50. And I think the reason to do SDL at this point is SDL is state development loans. Just like the government of India has borrowings, which we know as GSEC, SDL is the borrowing of good quality states. It's also sovereign rated. And usually SDLs, Niraj, they trade above government yields but below PSUs because it is sovereign rating. Today, because of the circumstances around us and the borrowing, SDLs are actually trading at higher yields than PSUs. So for the investor, there's a very good risk-adjusted, return ahead where you're getting better yields than a pure PSU product, but at actually a very, very good credit risk profile. So that was the idea, and this is a 2026 product, and it comes at a time when actually yields have been elevated. So investors are coming in at a very good time.
So are you saying, Radhika, that tactically as well, because of the rates at which you mentioned SDLs are trading, that tactically it actually offers a good time? I mean, this is probably a good time. Maybe some other time it may not have looked as attractive.
Yeah, and if you look at the charts, and there's some interesting stuff in our presentation. So it's always been, our products have always been hold to maturity products, but tactically, yes, it is a better launch time. If you look at maybe 12 months ago, SDL yields were below PSU yields. Right now they're elevated. So for the end investor, there's a absolute level of yield that looks good, plus SDL relative to other things also looks good.
Okay. And Radhika, just trying to get the construct of the fund, a lot of people read stories, right, about how some of the states have really precarious financial situation. So could there be a concern, and could that concern be valid, that what if it invests in an instrument which may or may not be from a state which is not going to the best of finances, and can that endanger the investment? Can you talk a bit about that?
Sure. And so the construct of the fund is thoughtful. So it's a 50-50 and it's equal weighted is the index. So you have a pretty wide basket. I mean, the index actually has 21 securities between PSU and SDL, and that's why we kept 50% SDL. We are also, because it's an index, the methodology is such that you're going to keep the best quality and most liquid SDLs out there. So people should know about that. The other thing people should know is that SDL carries a sovereign rating. So while states may have their issues and state borrowings are higher, this is a sovereign rating product.
Okay. So you made a valid point, Radhika, that yields have spiked up and therefore there is that advantage that is there. There is also this concern, and I want to understand, how do you guys think about it, that there is a concern that yields may actually shoot up even more in the days, weeks, months to come. And could that cause volatility / MTM losses for people who invest in this product because they believe in it? Sure, they are long-term investors, but could the near term be a bit rough?
I think it's a great question, Neeraj. I think one is that you don't know whether yields will go up or down. I mean, these things are important. Nobody could have predicted what happened in February. We do two things. Yes, one, there will be short-term volatility in yields in all target maturity funds. We've seen that in our previous line of, I mean, we've seen Bharat Bond products go below the 1,000 NAV and sit at 990. Your investor has to know that he's coming in for a hold to maturity period. However, we did do one interesting scenario analysis that, let's say you wanted to invest for a 3-year period. This is a 5-year fund, but suppose you wanted to get out over 3 years and yields rose a percent. I mean, because you don't know, over 3 years, people say yields will fall, yields will rise. Nobody knows. Say yields rose a percent. Instead of getting the index yield of about 6.3, you'll probably get something closer to 6.1 because you will accrue the interest, but you'll have a little negative MTM hit. That 6.1 is still better than investing in a 3-year product today. So that's why we tell investors that even if you're coming for a 5-year product, if you have a 3-year horizon, your risk reward is not bad.
Okay, and I think there is because there's this table that is there in the Edelweiss presentation which speaks about this benefits of indexation as well. I think Pratik Oswal was speaking about indexation. A lot of you who might not be completely aware is this wonderful illustration which probably will come up on your screen as well, which just shows how, because of the benefits of indexation, and in this case even differential tax amount or taxable treatment as well, tax and cost, the quantum of returns vary quite significantly. Radhika, did I get the number correct that via this one, over a period, the returns could be as high as 5.97 versus in a traditional investment, say like a fixed deposit or a savings deposit, it could be sub 4?
Yeah, that's absolutely right. So, indexation in a sense is basically the returns over inflation is what gets taxed. The presentation assumes inflation of 4, which is actually super conservative. So you pay tax on the 2% incremental return. And yes, you land up at a post-tax number of 5.9 odd versus a traditional instrument of sub 4. It also, Neeraj, is because this is a passive product compared to active funds, this is very, very competitively costed. So even the total expense ratio, and we are very cognizant as a house that in a low interest rate environment, you can't have large TERs eating into end customer returns. So I think the taxation profile and the TER profile also help that.
Okay. Radhika, the other question is that the Bharat Bond ETF, right, when launched and even otherwise, it got some rave reviews and rightly so, right? It was a beginning of a culture of sorts, right, so to say. And it's an effective product. So my question is, somebody would think that why is it that when the Bharat Bond ETF is existing, it gives me the 5-year option for exit as well, which is that I'm there for 5 years, which is a long enough period, and it's giving me near about equal returns. Why should I bother with another product?
So you're asking me to compare two children of mine. But I think, if you look at the vision for the Bharat Bond program, it was to kind of kick off a movement of debt index funds and ETF products, and not just Edelweiss and AMC. And we happen to be leaders in this space. There are more people coming out with target maturity funds. So I think one, that is fantastic, Neeraj. You're moving from FMPs and, not transparent roll down structures to clear, transparent communication of when things are maturing and what the portfolio is, which is so necessary in the debt market. So the more of these, quite frankly, the better. In comparison to Bharat Bond, as I said, that was a pure PSU product. This is an SDL product. The similarest product you have in the market in Bharat Bond series is 2025. That's actually a 4-year product now, and that's pure PSU. This is 5 years. The yields will be higher because it has the SDL element. So it's got 1 year more and the yields are higher. And our endeavor is just like you have a Bharat Bond range, as you said, of 4 products, and more will come out in that program. You will have a PSU SDL range of products. And who knows, maybe you'll do pure SDL, maybe you'll do corporate bonds, AAA corporate bonds. So we want to open the market, to as many consumers as we can. And the Bharat Bond program is 30,000 crores in a year, and I hope this program grows just as well.
So you're effectively saying, Radhika, that it's almost two products with a very, very similar nature, just that because of the tactical part of SDL's trading at a certain level, the returns might be slightly higher than what Bharat Bond
is. About 20 basis points higher net.
Okay. Any other not concerns really, but any other points or maybe concerns that somebody who's putting in money in this product should be aware of, Radhika?
I think the very important thing for debt investors is do remember these are not short-term products and there will be fluctuations in the yield, and you can't panic. I've always said this many times on your show, Niraj, that we don't react to fixed income fluctuations as well as we do to equity fluctuations. When there's a 20% cut in small cap, nobody comes and gives me a call. But, when yields move a little 1% in debt, suddenly you take the fixed income very seriously. So I think that's very, very important. As long as you're coming in with a 3 to 5 year kind of goal, because it's a 5-year maturity and we've shown you the 3-year math, I don't think you need to worry. But realize that 3-year journey also is not going to be smooth in the sense. So that if you can keep in mind and just hold on, and that's what we've seen in Bharat Bond. We don't see too many complaints when people come. As long as you invest with the right expectations, I don't think you have a bad experience.
Great. Well, I think it opens on the 10th and shuts on the 16th, if I'm not wrong, Radhika.
Yeah, it opens on the 10th and it shuts on the 16th. And it is slightly structurally different from Bharat Bond. That was an ETF. And it had a fund of funds. This is an index fund. I think one of the things we found, Niraj, in the Bharat Bond experience was that the fund of fund vehicle became very popular. It went from 1,000 crores to 6,000 crores this year. A lot of retail investors like the format of not having a demat account and like a mutual fund, doing an SIP into funds like this. So it met a lot of those goals. So hence we thought we would bring the index fund format. We've done that with some of our other equity funds also. So we said the index fund format is a very retail friendly format.
And that's a pertinent point. Great. Radhika, really good of you to join us today and explain this. All the best with the NFO. And thanks so much for taking the time out today.
Thanks. Always a pleasure talking to you.
Likewise. And viewers, I hope you benefited from this conversation. Thanks for tuning into the Mutual Fund Show.